Check, please.
Welcome back. Today we're talking about Taiwan Semiconductor Manufacturing Company, TSM. We'll go over the financials of this huge company that probably a lot of people haven't even heard about. We'll talk about what they've done in the past and moving forward in terms of what stock price you should be paying. We'll use our stock analyzer tool and our amazing software, which you can have. I'll tell you all about it. I follow Paul and Mo because they own over $100 million in assets. I've seen it. I've been there. We just got back from Mexico, and I trust them with making decisions, and you can too. Check out this video. Here we go. Paul, give me your thoughts on TSM.
Thanks, Seth. I appreciate it. Guys, follow us on Instagram, Everything Money Investing, and follow us on our personal accounts because Seth, Mo, and I have great personal accounts, and we don't want to be ignored because our egos are very fragile. So
the world's largest dedicated chip foundry.
Yep. So let's go to Everything Money 8-pillar software, TSM, Taiwan Semiconductor Manufacturing, blah, 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 blah. All right. So guys, first things first, let's look at this 10-year chart just to see how much fun. Oh my God, look at that chart. So it's currently at $140. 10 years ago, it was at $14. That's 10 times growth. So guys, this is a $730 billion company.
Aren't you shocked by that number? You said this before with NVIDIA. It's like the biggest little company no one's ever heard of. If you're just a normal person in this world, if you ask my mother what Taiwan Semiconductor is,
if you're going to ask me 5 minutes ago what it was, I'd say, $70 billion, $50 billion, and it's 730.
Jeez, amazing.
Guys, pillar number one, we want the 5-year PE under 22.5. It's 48, over double. That's an X.
Okay.
Pillar number two, we want the 5-year return on invested capital greater than 9%. It is 9.7. That's a check mark. So they do a pretty good job of getting a return on the capital that's invested in the business through debt and equity. Is there a dividend? There is a dividend. Oh boy.
Talk to me.
Red flag.
How was this?
1.3% pays out $9.4 billion a year. Seth, what do I always say about dividends?
Well, they can't pay for this, can they?
They can't. Look at this, guys. So, guys, remember, dividends aren't always secure. People assume they're secure, and it's the biggest rookie move in the world. You have to compare their dividends to their free cash flow. Guys, last year's free cash flow was $10.5 billion. And in the last 5 years, they've averaged 8.3. So they ate up 90%, 95% of their dividends of their cash flow last year. That's a lot. That to me does not scream a safe dividend yield. I don't like that, but we'll look at more in the future. Pillar number 3, we want to see revenue growth over the last 5 years. Go to our income statement, $35 billion to $52 billion. Check mark there. But keep in mind, guys, look at this big pocket right here. Very little growth between 15 and 19. 31 to 38 billion. It's a lot of growth in the last 2 years. Is this sustainable? Well, we've seen a big jump in demand for semiconductors. So in the chips, this might be a bloop. It might be a blip or a bloop. What am I looking for?
Bloop is a great word.
Our producer, Tim, just said this. Seth, go ahead.
Well, yeah, Tim is saying, don't you think they're putting chips in everything? I mean,
yeah, they are.
So is the demand for this will most likely increase drastically?
Perhaps. But remember, guys, we saw a big jump in the last year because of a big shortage of chips. Right? It's not because of major demand. It's because of the big shortage. Maybe because of demand, but is that sustainable? Will we always have a big chip shortage where they can just drive the price up forever? Your job as an investor is to be conservative and find the companies that sell for less than your conservative assumptions. Are we going to have more chip demand in the future? Absolutely. The question is, will there be a big chip? Because guys, these go in ebbs and flows. All of a sudden, a lot of demand. Great. Let's go make a ton of chips. All of a sudden, you flood the market with chips. And then what happens?
Yeah, even as you say that, I win, because it's just not fun, Paul, to patiently wait for this company to get into the sweet spot. You see a PE of double, and you're like, I know where this video is headed, but
I know.
So then, naturally, the dummy that am, I switched right to the news here, and Samsung planned to be the world's biggest semiconductor in the next 10 years. Oh, but hold on a second. TSM, they're investing a lot more. They have plans to be even bigger, yada, yada, yada. And it's like, oh, great, I'm convincing myself that this is going to be
with every company we can find good news and bad news that justifies our valuation and our ideas, right?
Mm-hmm.
It's confirmation bias. Like we only focus on the information that we justify. And trust me, we're all humans. We all do it, right? But the great part about investing is if you're good at taking out the noise and being more objective about things and saying, wait a second, if everybody believes this, why should I believe this? Because to me, I always look at things and say, everybody's usually wrong in masses, right? So that's just it.
Pillar number 3 is revenue growth over the past 5 years.
We already did that one. Pillar number 4.
Profit growth. Let's do that one then. Let's double down on it.
Seth just came in from the snowstorm. 12.4 billion to 20 billion. But again, look at that profit number. It went from 11.95 to 20 in a matter of 2 years.
They're doing really well?
Yes. Pillar number 5, we want shares outstanding staying the same or decreasing. Guys, if a company has 10 shares, you own one of them, you own 10% of the business. They buy back 2 shares, you now own one of 8 shares, which is 12.5%. You did nothing but be a dedicated shareholder, and your ownership went up from 10 to 12.5%. That's what you want to see. Okay? So we scroll all the way to the bottom. Now, I actually go to the 6th year here because we want the end of the 6th year, which begins the 5th year, 5.19 billion in shares. I guess it didn't really matter. It's been the same for the last 10 years. So
Paul, tell me this. I always ask you, when I invest in these companies and they make this great profit, I don't actually see this. But in terms of free cash, I can see it in terms of a dividend. Now, when these shares drop down and I own more and more of the company and they issue that same dividend, that's better, right? Because the dividend could possibly go up, but their free cash goes up. They have more money to give out a dividend, and I own a greater percentage of the shares.
Yes, and that's the whole point. Yes, you don't get a check at the end of the year for what's in the bank account, but if you own a piece of that bank account, which is essentially what you do, when you buy a share of stock, you own a piece of a business. As Charlie Munger says, if you don't own a piece of a business, what are you buying then when you buy a stock? You're buying a piece of the business, which gives you an ownership interest in all of its debts and assets. What was that, Tim? Lotto ticket. Yeah, that's exactly what it is. A lot of people are buying a lotto ticket. So you will see it in some way, shape, or form. If the company has $0 in the bank account today, let's say for the next 10 years, it does $1 trillion in cash flow. All of a sudden, it has $1 trillion in 10 years. What are they going to do? They might just issue a $900 billion dividend, and you get a huge check. What would you pay today to get a $900 billion check in 10 years? You'll see it eventually, but it might just take some time. You'll see it through paying down debt. All right, pillar number 6, we want to look at debt. So we go back to the main page. We go to our 5-year free cash flow number, $8.38 billion. We multiply it by 5. That is $42 billion. What did I do wrong here? It is $42 billion. We did a software update in the middle of this, this beautiful analysis. So $42 billion. We want our long-term liabilities to be under $42 billion. So we go to the balance sheet. We scroll all the way to the bottom. $21.7 billion. So they actually don't have a lot of debt. They can actually pay off their debt in a matter of 2.5 years if they use their free cash flow. But remember, they're using their free cash flow to pay out that big dividend. That really concerns me. All right. Pillars number 7 and 8 have to do with free cash flow. Free cash flow is?
Cash from operations minus capital expenditures.
And the 5 things you can do with it are?
Oh boy. They can issue a dividend, which they are. They can buy back shares, which they are not at the moment, but they're not selling off. They can buy, what else can they want? They
pay down debt.
Yes.
They can make acquisitions. They can invest back in themselves.
Keep going.
So guys, we make the math easy for you. We added this free cash flow line here on the cash flow statement to make the math easy. 6.5 billion to 10.5. Check mark there. But again, look at their last 10 years. There was one big fluke year, one fluke year, one fluke year. All right. So our final metric, we want to come up with a market cap of the company based on free cash flow. It's a starting point on where we want to be. We look at their 5-year average free cash flow, 8.38. We multiply it by 20. That's $168 billion.
Oh my God, come on.
And what's the market cap?
728.
Versus 728. Massive X, guys. This company is selling for 5 times more, 4 times more the number we come up with. So let's go to the 8 pillars tab to show you guys all this. Okay, so guys, essentially, we love this company except for 2 things. The valuation. All right, now, guys, does this mean this company is overpriced? Not necessarily. Every investment is the present value of all future cash flow. We don't know the future, so we have to make assumptions. That's why we created the stock analyzer tool, probably the most popular part of our software. What we do here is we input assumptions in the future, and it tells us exactly what we should pay for the company today based on those assumptions. So let's go do that. We're going to do a 10-year analysis. You can do between 1 and 20. Now, as you see here, it has the 1, 5, and 10-year data here. You can use that as a reference point, but my job is to be conservative. So revenue growth, I'm going to go 5, 8, and 11% revenue growth. Profit margin, I'm going to do 33, 34, and 35. Free cash flow margin, I'm going to do 18.5, 19, and 19.5. Now PE, 13, 15, 17, 13, 15, 17 on price to free cash flow. And finally, our desired annual return of 12.5%. Why 12.5%? You can invest in an ETF and not do any work and make 9 or 10%. So in order to get an ample return for buying an individual stock and have proper margin of safety, do 12.5%. Remember, guys, you cannot change the price you pay for a stock. The second you buy it, that price is locked in. So your job is to be conservative and buy it at the lowest possible price. Does that mean it's not going to go lower? No. It could still go lower. But if you do your analysis the right way and you believe that you buy a piece of a company, a share of a company, then you would keep buying more shares.
Paul, can you please explain to the people, and including myself in the comments below, why for revenue growth you put 5, 8, 11, and last year it was 25%? What gives?
Last year was if COVID had affected them where the revenue had dropped in half, would I continue 50% drop in revenue for the next 10 years? No, I wouldn't. But last year was a big fluke year because of the increased demand in semiconductors and chips. So I have to assume that's not going to continue on forever. Now, let's look at the company now on these numbers, and then we'll change the numbers for another level, see how overpriced it is, if it's overpriced. So we hit the analyze button. Guys, look at this. The company's 140. I have a low price of between 25 and 45 and a high price of between 50 and 90. And in the middle is around 50 bucks. Guys, this is just overpriced. It's just massively overpriced. Now, let's go make those assumption changes for revenue. Let's go 10, 13, and 16. Analyze. Still overpriced. Guys, it's massively overpriced. That's it. All of these numbers are in red. It's just massively overpriced company. I went and did the biggest numbers on that sheet, and I assumed them for the next 10 years, and it's still overpriced.
So yeah, again, the people below will say, Paul, you don't get it. This company is going to lead the way. It's better than Samsung. And it's going to have this 40%
It's amazing to me
return
how
every year.
We do 20 videos a week, and in 17 of them, I say they're overpriced, and people say, Paul, you don't get it. The company is the future. How is it possible that every week I ignore 17 companies that are the future? How many companies are really going to be the future of this world?
I think in this day and age, the outlook is so bright and been so crazy that they think all.
Great.
They think all.
20 years from now, the number one companies in the world will probably not be. Go look at the number one companies in the world from 20 years ago versus today. Which ones are still around, or which ones are still the top companies in the world?
You know, it's funny, Paul. If you go back to the metrics page real quick, and you can see, go back to the 10-year. You can see this company just chugging right along, just being sort of a normal company. And then right in 2018, when we started our show, you started saying, wow, the market's really overpriced. Then we get this huge explosion. If this is not so I guess the point is there's two options here. As a value investor, you can say, wow, that's a huge explosion. I got to avoid this and wait till it gets back into my undervalued sweet spot. Or the opposite is, this is just going to keep going. Look at this go. Look at this run. This is incredible. We should get in now because it's always going to keep going. You know what I mean? So
yeah, I mean, listen, guys, if you're looking at that, you're looking at the stock price. You're not looking at the company and the fundamentals of the company. I prefer to look at the fundamentals of the company, and that's it. To me, when I'm buying a company, when I'm buying a share of stock, I'm buying a piece of a business. Would I overpay for what I perceive the best of the future to be? Absolutely not. Does that mean I know it's a no? But your goal is margin of safety. The more margin of safety you have, which means the cheaper you pay. It's funny. What do I always say? I used to always say risk is the price you pay. I've never heard anybody say that before. Last night, I finally saw it. In my Charlie Munger quotes books, Ben Graham, the father of value investing, talks about how risk is purely the price you pay. The less you pay for something, the less risky it is, because risk is a potential loss of capital. The less you pay for something, the less potential cost of capital you have.
That is our take on Taiwan Semiconductor. It's funny, Paul. We get a lot of FUD out there about investing in Chinese companies, but I haven't heard anyone doubting Taiwan. I know they're obviously different places.
Well, no, we get a lot of FUD about Chinese companies when it's selling at prices. Alibaba has fallen by 2/3, and now people are scared about the risks of China. But when it was selling at 320, we wouldn't care about the risks of China.
You're right. If you're interested in getting the software behind Paul, you can make better decisions about your finances. Paul, tell us how you get this.
And the reason we created all this software is because as we made videos of the company, people would reach out to us and say, hey, how do I analyze my own companies in order to do the analysis versus waiting for you guys to make a video? So we created a software. You get everything you saw here. You get everything on the main page that's also coming soon, right here to the right side. You get 30 years of financial data. You get access to Seth Moe and I in our exclusive Everything Money chat here at the top, EM Community Chat. You get the Stock Analyzer tool. You get real estate calculator, retirement calculator. You get 8-pillar portfolios, which allows you to put up to 50 stocks in a portfolio to tell you how all 50 companies do at once, or 20 companies, doesn't matter. But exclusive daily content. We make 1 to 3 videos a day that we post. They're called A Few Good Minutes. They're wonderful. Seth, Mo, and I make them. But most importantly, guys, is this EM community. We have over 6,000 people that constantly talk in the community about their investment ideas, because the great thing about the internet is it allows all of us who have a certain way of thinking to come together and talk about our investment ideas. We have people in there saying, hey, I'm looking at blah, blah, blah. I'm looking at Ford stock. What do you guys think? And people have a good, engaging conversation about it. This is all available, all in our tool, all of this for about $1 per day. Sign up now. $1 per day gets you all of this. For the price of a cup of coffee, you get all of this, $1 per day. Sign up. And the best part is, whatever you sign up for today, that's your price that's locked in, because the price goes up every single month. But you're locked in at the price you sign up for today. So $1 a day gets you all of this. No brainer, guys.
That's our take. Final thumbs up. Get the software. You will love it. You can analyze companies, and we will update you on TSM moving forward. And maybe one day it hits our sweet spot. But at the moment, it's a smidge of a price. So that's our take. Final thumbs up. See you next week.